Hi, I'm Justin Martin, a wealth strategist with Paradigm Life. Thank you for joining me here for this tutorial to talk about policy loans. Now, what we're discussing here is the ability to take a loan against a cash-rich life insurance policy. If you have a life insurance policy already in place, great. Hopefully this will provide you some information that you need to learn more about that process. If you don't have that policy already in place, let me know. Give me a call, send me an email, or here in the YouTube video, I have a link down below in the text that you can click on and we can set up some time to meet. Anyways, let's jump into this, all right? Now, when we're discussing policy loans, I think one of the easiest ways to go through this is just to run an example, okay? Now, the example that we're going to look at here is to say, all right, we're going to use our insurance policy. You're going to use your insurance policy to purchase your next vehicle, okay? So what we're talking about here today is car loan, all right? Now you have a lot of different options out there when you go to purchase a vehicle. You can go to the dealership and finance it. You can go to your bank and get a car loan. You can pay for that car with cash. You do have a lot of different options out there. What we're going to be doing is presenting another option saying, utilize your insurance policy as your own bank. All right. So let's take a look here. Let's say this circle right here represents your insurance policy, wherein you have cash value growing inside that policy. Now, again, the cash value is kind of your savings account position inside that life insurance policy. As a reminder, cash value has growth associated with it too. Okay, so the insurance company gives you a guaranteed interest on that policy, on that cash value. Now, for this example, we're going to say that growth is 4%, plus, because of the way this policy is set up and with the insurance company that it's set up with, you also get the possibility of a dividend inside that policy. For this example, let's say that dividend rate is 1%. So today we're going to say your growth on this insurance policy is 5%. Now, those rates right there and whatnot, let's talk about that more in detail and exactly how that works. But for today's example, let's say 5% is what you're getting in that policy. Okay? Now, you're ready to go purchase that car. This is a very simple process as far as getting the money. What you're going to do is you're calling the insurance company and saying, "Hey, insurance company, I've got a whole life insurance policy with cash value, and I want to borrow against that cash value." The insurance company says, "Great, you can utilize your cash value as collateral, and we will send out to you from our reserve account $10,000." Okay, so that $10,000 that you requested comes out to you. Now the insurance company says, well, because you're borrowing against your insurance policy and that money's coming actually from our reserve account, not from your policy, we're going to charge an interest back on that money. In other words, you're paying for the opportunity cost that we lost as the insurance company of not being able to invest the money ourselves. So we're going to charge you a 4 to 6% interest. Now that's going to vary a little bit. Typically you'll find that it is somewhere between 4 to 6% interest. For our example today, we're going to say the insurance company charges you 5% interest back on that policy loan. Okay, so let's run this example and see how all of the numbers shake out. See what the actual interest payment is that you have to pay. See how much growth you're getting in that policy. Okay, so I'm going to pull up here a suite of calculators. These calculators that I'm going to be using come from what is called Truth Concepts, truthconcepts.com. It's a suite of videos that helps us better and more accurately analyze the numbers associated with these insurance policies. Okay, now we have here, I'm working on the left side of our screen here, the car loan. Let me relabel this. Car loan at $10,000. Okay, so we're going to say we're taking a car loan for $10,000. Now, first number here, our loan balance, $10,000. Our loan rate, again, 5% is what the insurance company is charging. Now, months to pay back. One thing that we need to note here is when you're paying back a loan on your insurance policy, that payback is, you're in control of that payback. You're in control of the terms of that loan. So you pay that back when you want and how you want to. And the reason why you have so much flexibility in the payback is because of the low risk nature of this loan. Ultimately, the insurance company will get their money back. Okay? They're holding your cash value and your death benefit as collateral. In other words, if you pass away, if you die, and you've got an outstanding loan, the insurance company is going to utilize a portion of that death benefit payout to satisfy that loan, and then the rest of the money goes to your family or to your beneficiary. Okay? So you get to decide how you want to pay this back. Now, the payback on this example today, we're going to say you're going to pay back this loan in the similar fashion that you would if you went out and got financing yourself. Okay, so you went out to the dealership and got a car loan from them. That kind of a payback is usually going to have a 3 to 5 year payback. Okay, so for this example, let's say you're going to pay this back over a 5-year period. Multiply that by 12 because there's 12 months in a year, and let's go 60 months. Okay, if you pay that back over 60 months or 60 payments, then you're going to pay $188 per payment per month. All right, we stretch that out over time and we get our basic loan amortization, your pay down on that loan. Okay, part of it goes to interest, part of it to principal. We have the $188. Now, the column I want to look at here is this interest charged. We're going to add up all of this interest and say, how much interest did you pay on this policy loan? And if you take a look at the number here at the bottom, that total amount is $1,323. Okay, so let me come back here to my tablet. And let's write in here $1,323 is the total interest paid on that policy loan. Okay. Now going over here to our policy, let's now calculate the growth that we had inside that policy. Okay, so here's our next calculator. We have $10,000 inside of that cash value. That cash value, for our example here, is growing at 5% per year, and we're calculating all of that over this same 5-year period. Well, at the end of that 5-year period, our $10,000 has grown to $12,763, or you could say we had an earnings of $2,763. Okay, $2,763 was your earnings. Now, if we take that earnings and we minus out this interest, the difference between those two numbers is $1,440. Basically, what we're saying here is because, let me get this line out of the way here, $1,440. Because you decided to utilize your insurance policy as a bank, instead of going out and paying for that car with cash, you're actually $1,440 ahead financially. Okay? And it's not really due to any kind of an interest rate arbitrage or anything like that. It's due to two different things. The first is you've been able to leverage your dollar in a very safe way. That $10,000 is growing in your policy while you're also utilizing it in the form of a loan. Okay? Used it 2 different ways. And then on top of that, we're also saying, let me draw a triangle here. This will help us out. We're saying this is $10,000 that's being paid down on a simple interest rate. You start with that $10,000, and month by month, you're whittling down that payment. Whereas over here in the policy, you're starting at that $10,000 and growing that over time, or we could say you're compounding that money. Okay, so we get this simple versus compound. Now on a day-to-day basis, this would be just be a wash. But when we involve the time value of money in all of this, that's when we see this $1,440. Okay. Now this is just a quick example, but as you start to think through your policy and how you can use it, this can be used for whatever kind of expense or investment that you're utilizing. A lot of you I know are real estate investors. Okay. What if that $10,000 was going to be a down payment on a single family home? What is that going to do for you? Okay. So you can start to see this being utilized in different ways. All right, now I want to add on top of this a little bit. Okay. Now, when you go to pay for that policy, well, let me back up here. Let's go back here. As you're reading up on this perpetual wealth strategy and this bank on yourself concept, this infinite banking concept, you'll hear a lot of different authors and advisors and agents talk about paying yourself back more. Okay, which you can. All right. What you're doing here is, let's say the interest with the insurance company is 5%. Well, you're running your own banking system here through your insurance policy. Let's say you decide to pay yourself back a little bit more. Let's say you paid yourself back 8% interest. Okay? If we did that, we're saying $188 is still going to pay back the policy loan. And then we have this excess payment of $14. Now that $14, in essence, we're directing that money towards the cash value. Extra payment going back into your system. So in this case, by paying that extra $14 per month, if you look down here at the bottom, we've now put another $843 into the policy. Okay? So it's very likely that you will have another $843 that you've plugged away into this insurance policy by paying yourself back extra interest. Okay. Now, the payback on this policy loan is a little bit different than what we're used to at the bank. All right. This line right here, this line represents the timeline of your insurance policy. I'm going to put a 3 here, a 4, and a 5. This means anniversary date 3, anniversary date 4, and anniversary date 5. The premium payments going into your insurance policy always revolve around the anniversary date. You make your annual premium payment. Everything calculates to that anniversary date. Well, the interest on your policy loans also revolves around that anniversary date. Okay, here's what I mean. Again, let's say we've got that $10,000, we want to take a $10,000 loan. Now, let's say you take a $10,000 loan on the 3rd anniversary date of your policy, and let's say the interest rate is 5%. Well, the insurance company, what they're going to do is they're going to do an assessment of the interest over the next year. Then they're going to say, for this next year, you owe that interest up front. 5% of $10,000 is $500. So you owe $500 interest up front. So when you request this $10,000 loan, the insurance company is going to send you $10,500. Okay, now you start to make those premium payments back. But let's say 6 months down the road, let's say you pay off that policy loan. Okay, you paid off all the way. Well, if you paid off that policy loan all the way, the insurance company has taken 6 months too much worth of interest. So the insurance company is going to do a quick calculation, and they're going to credit back to your cash value $250. Half of that, okay? But let's say you don't pay off that policy loan. Let's say we get to the 4th year of your policy, and let's say you still have $10,000 outstanding. and let's say the interest rate is still 5%. Well, the insurance company is going to do another assessment of your policy, and they're going to say you owe $500 for this next year. At this point, you have a choice. You can just write a check to the insurance company for $500. You can use some of the growth of your insurance policy to pay that $500. You can use your dividend to pay that $500. In most cases, what happens though is this $10,000 now becomes $10,500. Okay? You just have a larger outstanding loan. It just adds on itself. Okay? And then you're working on paying this $10,500 off. Now, as you're processing these policy loans, you'll notice here this is running on a day-to-day basis. So everything is calculated on a day-to-day basis. So that interest that they're going to take is going to be a pro rata amount based upon what day, what period of time you're taking that policy loan. Okay? The other thing to note here also is the insurance company doesn't view it as here's one outstanding loan, here's another outstanding loan. It's almost like a line of credit. Whatever your cash value is, you can borrow up to that amount. Okay? And you're able to just ebb and flow with however much that cash value is. All right? I want to thank you again for joining me here as we discussed policy loans. For more information on this, make sure you contact me, jmartin@paradigmlife.net. My number is 801-210-1878. Or down in the YouTube video, you should see a link there that will also take you to our website where you can contact me there also. Again, thank you, and we'll see you again soon.